Hello, I'm Daniel. I want to talk to you about an article called The Certainty of Uncertainty that was published in the review recently. Basically, this article has to do with the fact that our global funds' exposure to cyclicals have slowly but surely increased over the last 2.5 years. And it has now become a significant investment exposure when taken in combination. This is important to communicate with you in this regard. Half of this exposure is in energy. That's primarily oil and gas businesses. And the balance of this exposure is in commodity extractors with a large allocation to platinum. There's also exposures to steel, and also in the aluminum sector we have found good value. The market is infatuated currently with companies that exhibit predictable earnings profiles and low volatility. And because the market's fallen in love with these companies, their prices have been bid up to overvalued levels, which we think is unsustainable. And it also makes owning this earnings certainty a highly uncertain investment proposition. So one has to draw a very important distinction between earnings certainty on the one hand, but at the end of the day, it comes down to the price you pay and the value that you get. The market's former love affair with cyclicals from the mid-2000s have turned into hatred. Best word to describe it is hatred. Their share prices have been smashed, making owning this earnings uncertainty a highly certain, in fact, very attractive investment proposition. And that is what this piece is all about. The payoff between price and value, and the understanding that the market is really in love with earnings certainty, and the market is really despising earnings uncertainty at the moment. And the very interesting thing about cyclicals, generally speaking, when they are really in trouble, they don't make money. So they don't show traditional measures of value, such as a low PE ratio or high dividend yield and that kind of thing. So it's very difficult to look through the portfolio and run a price to earnings measure on the whole portfolio and make the argument that this looks like a classic value investor's portfolio when it's full of cyclicals. So there's a lot of sleight of hand happening to make the portfolio not look like it's full of value. And that's one of the things that we, of course, know and we understand. But perhaps also would be useful for you to understand that we don't just go out there and buy cyclicals. We have a very, very deliberate approach, well-considered approach to buying cyclicals. And the companies that we have found globally to invest in are best-in-class operators in their respective industries. They're low on their cost curves globally, so they are high-quality operators. They have long-life assets. They have dominant market shares. They have robust balance sheets, or at least the ability to pay down their debt very quickly. They have sensible management already in place, or has recently gone through a management rotation to new sensible leadership. And they also have strong, long-term oriented shareholders that can see them through the trough in their business cycles. So these are some of the things that we very deliberately put through a matrix when we're looking at making investments in cyclical businesses. And we believe that this will stand our clients in good stead over time. So to wrap up and in conclusion, we believe that owning the near-term earnings uncertainty represents a very attractive investment certainty. Thank you.